So I'm going to do three things today, and talking about taxes is always like the most exciting part of everybody's day. I'm going to do three things, and I think it'll be relatively painless, I hope. The first thing I want to do is review Arkansas's tax system, and then I want to discuss a few of the recent changes to Arkansas's tax system, many of them that already are affecting you or that will affect you in the future the next time you file your income taxes or something like that. And then finally, I think that there's a couple recommendations that we might all be able to agree on that could improve the simplicity of the state. Before I do that, I'm wondering, what majors do we have in the room here? How many accounting majors in the room? How many economics majors? What are other things that I need to be asking? Because that wasn't a lot of people. What other majors am I looking at? History? Marketing. Marketing? Business management. Okay, so I'll use, for the most part, I'm going to try and use terms, I'm going to define terms as I use them, but I think that there's a lot that we can learn today together. So first, before I start, I want to tell you a little bit about the Tax Foundation. Jeremy mentioned some things, but I'm going to go into sort of what our publications are and what the mission of our organization is, because we're an educational organization. We're an independent, nonprofit, nonpartisan research group. We're a think tank. There's a lot of them in D.C. There's like a ton of them in D.C. And we fit sort of into that umbrella in that we are studying issues that are happening in public policy and trying to make recommendations that lawmakers can consider to improve public policy. But even though we're independent and nonpartisan and try as much as we can to be a neutral voice, we do have some values. It doesn't leave us devoid of perspective. We believe in a certain set of principles, and these are principles that have been followed by public finance experts since as long ago as Adam Smith, when he laid down The Wealth of Nations in 17something. And on page 700 and something, he actually lists some maxims of taxation, some principles of tax policy that have served as a sort of guiding light for analysts that study these types of issues. The first of those is that taxes should be simple. This is the thing that like everybody agrees on. If you talk to folks about what their biggest problems are with taxes, it's usually that they're very complex. Across party lines, people say taxes are too complex. We want a tax system that's more transparent. You want to know what your taxes are and when you're going to pay them. And if you don't know what those things are, that can result in some pretty difficult situations for businesses and individuals. You want a tax system that's stable. You have a tax system that's constantly in flux. That makes it really hard for individual or business planning. And you also want one that provides for stable revenues. If revenues are constantly in flux every year over another, dipping into surpluses or maybe going into deficits each year, it makes it difficult for government to plan. And then finally, and perhaps most importantly, we want a tax system that's pro-growth. And we've been advocating for these principles for 79 years. We were founded in 1937. Please come on, find a seat. We were founded in 1937. That makes us one of the oldest think tanks in Washington, D.C., definitely the oldest one dedicated to tax policy. We've got a wide range of products, and I'm just going to kind of fill the screen with some stuff that we do in any given year. The first one is we do a lot of research. Here's our State Business Tax Climate Index. This is a product that I've co-authored for a couple of years. It ranks the states on the competitiveness of their tax code. We're going to talk about that a little bit later. We do a lot of reporting of dispassionate data. Government websites are really hard to navigate, so we've been publishing tax data on our website or before websites in a publication like this. This is called Facts and Figures. We've published this publication in some form or another since 1941. Pretty cool. And this is just sort of where states rank on a variety of tax measures. We also are updating fresh analysis every single day. We have a blog that gets like 4 or 5 million views each year, and I encourage you to make it one of the startup tabs on your Chrome browser or whatever it is that you use for browsing. Every single day we've got 3 or 4 new blogs on there discussing what's happening in the federal level federal level on tax policy or at the state level on tax policy. It's a good way to keep informed and an interesting way to think about those issues. We have a federal center, which is, these guys are like burning candles at both ends, working on the presidential candidates and all the proposals they've put forward during the campaign this year. And you can review really a ton of analysis, but if nothing else, I'd encourage you to find this sheet right here that shows the candidates that are still in the race and what their tax plans would do to GDP, to job growth, to all sorts of other various measures if their tax plans were enacted in full. And that's on the very front page of our website if you go to it. We have a state center as well. One of our favorite things to do is go into states and provide publications that are designed to compete with tax commission reports. Sometimes legislatures will approve a committee of tax experts to come in and try and offer recommendations for their tax code. And usually those reports are pretty dull. There's a lot of text, maybe a few tables, and then they sit on a shelf for a couple of years. We have a competitor product to that, which is much more colorful, tries to tell the story of taxes in shapes and colors, and then makes recommendations about how the state can improve their tax code. In North Carolina, we did this, and it resulted in a really substantial tax reform in their state. They actually did so much good work on their individual income tax, their corporate income tax, and their sales tax that they improved from the 44th most competitive tax system, so one of the worst tax systems in the country according to our index there, to 16th in 1 year because of the changes that they implemented. And then we also do some work at the local level. We did a book on San Diego a little while back. All right, so how do we rank Arkansas? There's two ways that you can think about taxes in your state. The first one, and the one that people are the one that I generally get as the first question is, how much do residents in my state pay? It's usually a question of how much. That's how the question is phrased. And we've got a report for that. It's called the State Local Tax Burden Rankings. We just put out the newest edition, which uses 2012 data, so it's a little bit of a data lag as the census data is slow. And we show that Arkansas taxes are middle of the pack toward the higher end of the pack. When you take tax burden paid by residents in the state and put it over total state income, you get 10.1%. So it's the 17th highest in the country. Relatively high for a southern state, actually. If I throw the map up here, you can compare Arkansas to its neighbors. Louisiana, of course, is a much lower tax burden state. Texas is known for lower tax burdens. Tennessee, lower as well. Missouri, a little bit closer. A lot worse in the Northeast. Not the best that it could be. The other way that we can think about taxes, and this is the one that I think is much more gratifying, and it's not just because I'm one of the authors of the study. One of the more gratifying ways to think about taxes is to think about tax structures. This is what our State Business Tax Climate Index does. It's a comprehensive look at all of the elements of tax law that go into making a system that businesses and individuals ultimately have to comply with. And we look at over 100 variables that go into this study. And if you look at the tax structures of each and every state, the cool thing about this report is that it spits out a rank at the end. And in Arkansas, the state ranks 38th. So not as good. One, in this case, would be the best tax system, or the most competitive tax system, or the most broad-based, low-rate tax system. And 50th is the worst, so 38th in the state. And here's that same map showing these rankings here. You can see that Louisiana, a border state that has a much lower tax burden, looks like they have some serious structural issues. See, they rank 37th here. Even though they don't collect a lot in taxes, they have a system that's duplicative, they have very narrow tax bases, they have very high tax rates compared to their neighbors, and so even though they don't collect a ton of money in tax revenue, they've got some serious structural problems. Texas, on the other hand, low tax burdens, and also a pretty good tax structure. They don't have an individual income tax. All the states up in the Northeast, they collect a ton of revenue in taxes, and they also have pretty poor tax structures. And then there's Arkansas with 38th there, being a state that has moderate to high tax burdens, but still has issues with tax structure. And I think those issues with tax structure are the most important thing that we want to look at today. So in the report, we break things down by type of taxes. For most of us, the tax that we most interact with is the individual income tax, or maybe the sales tax. These are the things that consumers pay. But businesses have to comply with 5 different tax types in every single year. And all of these are ultimately passed on to you as a consumer who buys products. or a person who's employed at those businesses. So we look at 5 different tax types in this report here. We look at the corporate income tax, we look at the individual income tax, we look at sales taxes, we look at unemployment insurance taxes, and property taxes. I'm going to go through each of these 5 to show where the state ranked within these tax types. The corporate income tax is a pretty poor ranking. This is actually one of the drivers of Arkansas's poor overall score here. The top rate is 6.5 in Arkansas, which is, again, not competitive with a lot of states. Louisiana, again, I mentioned Louisiana has a lot of very difficult tax problems that they need to deal with. But Arkansas has a higher corporate tax rate than Oklahoma, higher corporate tax rate than Mississippi, slightly higher than Missouri. Texas has a very different tax system, so it's omitted from this map. They have a gross receipts tax, which is problematic in its own ways, but they don't have the traditional corporate income tax. And then there's also a lot of structural problems. It's not, one thing to remember about taxes is that it's not just the tax rate, but it's also the tax base. Arkansas has some very unique problems with net operating losses, which is a concept where businesses, if they have a year where they lose revenue because they made a lot of capital outlays in a year and didn't bring in a ton of profits, usually they're allowed to carry forward those losses or carry back those losses to previous tax returns, so that in any given year they're paying close to what their average tax rate would have been over like a 10-year period or something like that. In the federal code, we generally allow businesses to carry forward net operating losses for 20 years. We allow them to carry back net operating losses for 2 years. In Arkansas, the provision is a lot less generous, actually. You're not allowed to carry back losses at all, and you can only carry forward losses for 5 years, which might seem like a pretty decent time for you and I. If we incurred losses in a particular year, we might only need to carry them forward for like a couple of years. But for businesses with long time horizons, this really matters. Arkansas also has a lot of incentives. They have a lot of tax carve-outs. Let's phrase it that way. Incentives for businesses to create jobs within the state. That you might be saying, okay, creating jobs is a great thing. That's the type of thing we want to incentivize. Maybe we give certain businesses a tax carve-out or a tax benefit for providing a certain number of jobs in a given year. But these things ultimately erode the tax base, the corporate tax base. They make it so that you have to charge a higher rate on everybody else, just to give sort of a little bit of tax favoritism to a particular type of firm. And all of these things count against Arkansas's score in the corporate tax component. Moving on to the individual income tax, we can see that the state ranks sort of in the middle of the pack as well. The top rate is 7%, and I can throw that up on a map here as well. Arkansas, in this case, again, highest in the region, highest in the South. Higher than Louisiana, higher than Mississippi, higher than Oklahoma, certainly higher than Texas, which doesn't even have an individual income tax. But there's also some really big issues with how the taxes are structured. How many people here do their own taxes? Raise them really high. I'm very, very proud of you. I actually use TurboTax. Is that funny? I thought that was funny. A lot of people don't know how tax brackets are structured, how tax brackets actually work. This is the individual income tax structure in Arkansas last year. They actually made some changes, which I'm going to talk about in a second. But the way that a tax bracket works, what's the first one? It's $0 to $4,300. The second one is all right, so most people think that the way a tax bracket system works, I've got the 2 brackets here up on the wall, is that your first $4,300 is subject to this rate, 0.9%. And then if you make $1 over $4,300, or in that case $4,299, all of your income is then subject to a 2.4% rate. That's not actually how it works. The way that you can think about tax brackets instead in your head is that they're like baskets. They're like baskets that you put your income in a given year. And let's say if I make $8,000 in a given year, my first $4,300 would be taxed at 0.9%. If anybody has a calculator, I'd love to know what that amount is. About $410. Thanks, Jeremy.
Or 41.
Okay. And then my next, from $4,300 to $8,000 is taxed at 2.4%. And then you add that whole item together, and that becomes your total income tax liability. All right. So you guys actually just learned something today that I watched the New York Times mess up a couple of months ago. They had a front page article where they mistakenly thought the tax brackets worked the wrong way. So you guys know something a little bit more about taxes. Okay, in Arkansas, the state has one of the weirdest, they just passed this last year, the state has one of the weirdest tax bracket systems that I've ever seen enacted. They have brackets within brackets, if that makes sense. So if you have income under $21,000, those are the income tax brackets that apply to you. And then if you have income between if your total income level is between $21,000 and $75,000, those are your tax brackets in the center there. And then if you have if your income is above $75,000, those are your income tax brackets there. And they passed this as a weird way of giving a middle income tax relief. Actually, I think it ended up, well, I'm not quite sure. I'd have to do like a hypothetical calculation of a particular taxpayer. They passed this as a way of giving some middle income tax relief. But it's one of the most complex structures in the country. And again, in many ways, the most important rate is this top one right here, 7.0%. And the reason that top rate is really important is because that's the rate that businesses are paying in the state. So you might be saying, okay, well, Scott, you just went over the corporate tax, and that has a top rate of 6.5%. What are you talking about? Individual income taxes mattering for businesses. Well, the individual income tax is, for all intents and purposes, just as important, if not more important for businesses than the corporate income taxes. Most businesses are actually structured as, and this is where my accountants are cheering me on here, most businesses in this country are now structured as limited liability corporations, LLCs, or they're structured as S corporations, or they're structured as sole proprietorships or partnerships. And that's everything other than what's called a traditional C corporation. And all of those corporations, sometimes they're called pass-through entities. All of those corporations, all of those business types, they're taxed through the individual income tax. So when you're talking about tax competitiveness, you're talking about actually the same tax code that you and I comply with every year when we go through our wage income and try and subject it to individual income taxes. Businesses are actually filing through that code too. They're absolutely allowed to. But businesses, it's really important for businesses to have a competitive individual income tax. On sales taxes, this is where the state actually probably performs the worst. What's the sales tax in Conway? Does anybody know? State plus local. 10.5. 10.5. Where does it in Little Rock? 11. Try buying a mixed drink, right? I know about the mixed drink tax too. That's right. Actually, Arkansas has the second highest sales taxes in the entire country. When you add the statewide rate, to average local rates, which we do every half year, we do a calculation of all the local rates that are charged in each of the zip codes in the entire United States. It's a really big spreadsheet. And you add them together, Arkansas, on average, 9.26%. A lot of areas higher than that. Though within the South, actually, the state kind of does okay regionally with a sales tax that's that high. Oklahoma, you can see pretty close by. Tennessee, a border state, has the highest sales tax in the country. Louisiana, also very high. Texas, very high. Mississippi, a little bit lower.
Because they don't have any income.
What's that? Yeah, Texas does it without an income tax, though, so a lot of people can get that trade off. Okay, so why are these? Why is the sales tax so high? Why is the sales tax so high in the South? Why is it so high in Arkansas generally? Well, actually, this is more of a history question. Most sales taxes are pretty narrow. They're very outdated and they're pretty distortionary. And the reason the reason for that is that most sales taxes don't extend comprehensively to services. Right? When you think of the sales tax, most of us think about it as the thing that the tax that we pay when we go and pick up like a book, or maybe if we buy something in a restaurant. But really, if we had a broad-based sales tax, it would apply to all consumption. Oftentimes, though, I listed a couple of other problems with sales taxes that we're not going to talk about. But the biggest problem is that it doesn't apply to services, and the reason for that is an accident of history. In Mississippi in 1930, when property tax revenues collapsed as a result of the Great Depression, and just in the 30s generally, when property tax values were sort of crashing, Mississippi was the first state to create a sales tax. And they wanted to create a tax on consumption. And at the time, consumption was almost entirely goods. It was almost entirely tangible personal property, stuff that you can touch and move and exchange with people. And that actually worked out okay for a while, because goods were 60–70% of the economy at that time. Fast forward to today, though, we have a much more service-based economy. I mean, there's stories written about this in the news all the time about how the United States in particular is moving towards a service-based economy. That's what we're all about. And that's a good thing. That's a good thing. Moving towards a service-based advanced economy is a really good thing. But if your sales tax only applies to goods comprehensively across the board, all these states that just copied Mississippi's sales tax statute haven't changed it very much since then. Your sales tax base is doing the same thing as that green line there. So every single year, if you have a revenue shortfall, or every single year if you want to invest in a new project from a government perspective, your sales tax is less productive than it used to be in terms of collecting revenue and bringing it into government. And so you have two choices. You can either expand the sales tax base to some services that are new, they might be hard to define, and those folks aren't used to paying taxes and really don't like collecting taxes, or you can just raise the rate a little bit. So the test of time has been that most states have raised their state sales taxes over the years. Year over year, average sales tax rates. If you laid the graph of average statewide sales tax rates across this graph, you would see that it's a direct inverse correlation. Every single year, instead of expanding the sales tax base, states bring sales tax rates up a little bit. And so that's part of the problem with sales tax here. Unemployment insurance taxes, I'm going to skip those because I don't want you guys to fall asleep, given that it's after lunch right now. But generally, know that unemployment insurance taxes, the rates in Arkansas are some of the highest in the country, and that drives a poor score there. Let's talk about property taxes. How many people grew up in Arkansas? How many people grew up somewhere other than Arkansas? Where'd you grow up?
Texas.
Texas.
Ohio.
Ohio?
Michigan.
Michigan? Anybody from the Northeast? Mish?
Connecticut.
Connecticut? Yeah, the property taxes suck up there, don't they?
Yes.
Yeah, they're pretty pretty bad. Pretty bad in Texas too, right? Your parents complain about your property taxes?
Well, my parents long ago moved away.
But from Texas, you're Texas, right?
Yeah.
Texas, your parents complain about property taxes?
I think so. I don't know.
Oh.
I don't really talk about it.
They seem like really nice people.
Yeah.
Okay, in Texas, they've got a lot to complain about. Their property taxes are some highest in the country. In New York and Connecticut, they've got a lot to complain about. Their property taxes are some of the highest in the country, too. Here's mean effective property tax rates on owner-occupied housing. And you can see Texas, 6th highest in the country. Connecticut, 4th highest in the country. New York, 11th highest in the country. New Jersey, 1st highest in the country. I once was talking to a reporter from New Jersey who told me that complaining about property taxes was a state pastime in New Jersey. I thought that was pretty funny. Arkansas, this is one of the problems that the state doesn't have with its tax code. Property taxes are relatively moderate here, 42nd highest in the country. If you do this on a per capita basis, that's the other way you can look at property taxes. Property taxes paid per capita. I think the state comes out like third lowest. People tend to really like that. I think property taxes are pretty efficient, but folks really hate paying them because it's the one tax where you have to stroke the check for the entire amount of the tax burden in a given year. Just wait until you buy a house. It's really great. However, here we go. However, even though the state has relatively low tax rates, there are multiple sort of arcane property tax instruments within this state that don't exist in a lot of other states. One of them I want to talk about real quick is the capital stock tax, or the franchise tax. Arkansas is one of just a few states, and you can see it's mostly southern states now, that levy a tax on net assets for businesses. So like your entire balance sheet, if you're a business, is subject to a relatively low rate tax, but a tax that's charged every single year. I once heard a business owner tell me that the capital stock tax, or the franchise tax, was like a tax on breathing. Because just by your essence of existing, it's not a tax on your real property, not a tax on your land, but just because you have a balance sheet, period, the entire thing is added up and then subjected to a tax each year. Arkansas has one of those. Arkansas also has a tax on business inventory. So businesses that have like a warehouse filled with stuff that they're planning to sell, Arkansas is one of few states that still taxes those items just because they're sitting in your warehouse waiting to be sold. I actually think that this is one of the worst type of taxes, the inventory tax. Because if you're bringing products into a warehouse and bringing them into inventory and letting them get sold or bringing them to the market, this is a direct tax on entrepreneurship. Does anybody know well, I think Jeremy can only answer that question. The word entrepreneur in French means undertaker. And Richard Cantillon, who is the economist who first coined the term, was referring to the risk that is being undertaken to bring products to market. So when Cantillon talks about entrepreneurship, he is literally talking about inventory building. And Arkansas is one of the few states in the country that still taxes your inventories just by the very virtue of you being entrepreneurial. All right, so this is the conclusion here. Arkansas has high taxes. They're much higher than a lot of the regional competitors, and they're pretty poorly structured. So you really kind of have two options when you get to this fork in the road. You can either cut rates and revenue, or you can reform your tax structure. And I think that both are avenues that legislators can consider going down. The first one, cutting rates and revenue, is actually relatively straightforward. Doing that is pretty easy. If somebody came to us and they said, hey Scott, we read your state local tax burdens study, we saw that Arkansas has relatively high tax burdens, what do we do? The answer is, do across the board cuts. That was a good way to sound it. Yeah. Do across the board cuts to individual income tax. Maybe cut the sales tax rate. Maybe do some corporate tax cuts. The more complex question, I think, is how to reform a state's structure. On the corporate income tax that we discussed, I think that going to a single corporate tax rate, right now you guys have a graduated structure, and lowering that rate overall is something the state could do to be more competitive, while even bringing in the same amount of revenue that it used to. It could be a revenue neutral change. You could fix some of the business provisions in the code. I mentioned net operating losses as a thing that really hurts businesses with cyclical profits. And then you need to clean up the code. Maybe remove some economic incentives that are being put in, or tax carve-outs that have been put into the code to try and benefit certain businesses at the expense of others. And if you're able to remove those elements of the code, you can usually gain a little bit of additional revenue and use that revenue to bring down rates overall. On the individual income tax, I think we need to get rid of that whole entire table that I just showed that they passed in the last legislative session. There's no other state that does it like that, and for good reason. It's very difficult to figure out what your tax burden is if you look at that chart. And in fact, for most people that don't even understand how tax brackets work, which everybody in this room definitely knows how the tax brackets work, there would be no way for you to plan and have an idea of how much is going to be taken out of your taxes each year and plan for your spending that year or your saving that year. And then again, to reiterate, bringing down the top rate really matters, especially for businesses, because they generally pay most of their income in that top rate. On the sales tax, I think it's important to consider broadening the sales tax base to services so that you have a true consumption tax, not a tax that's only taxing one portion of the economy at the expense of another portion of the economy. And if you do that, you can then bring the rate down so that when you go and grab a cup of coffee, you're not subjected to a 10 or an 11 or even higher percent tax. Maybe you have taxes that spread a little bit thinner on more transactions, but they're a little bit lower. On the property tax, I think the state needs to eliminate some taxes that have been in place for a number of years that don't make sense in a modern economy. And especially in a southern state where capital accumulation has been a historic problem, just everywhere in the South actually, capital accumulation since the Civil War has been a historic economic problem. Eliminating taxes directly on capital, directly on balance sheets, directly on items that you can use to invest, or directly on resources you can use to invest is really important. So the level of taxes matters. If there's one thing I want you to walk away with today, the level of your taxes matters in your state. Matters at the federal level too. But the structure matters maybe just as much and maybe more. So Arkansas has plenty of low-hanging fruit, and I think there's a lot of things in this sort of toolkit to unpack and work on. So with that, I'd love to open it up to questions. You can ask me anything about all the burning questions you've had about taxes since growing up. But I can talk about what's going on in other states if you like, or just any off-the-wall stuff that you'd like as well.